All right, we're going to start our panel. Immediately following our great panel discussion, we'll be having remarks by President Bill Clinton. To lead this panel, an incredibly distinguished panel, and one we're really proud to save for today, is Chris Ailman. He's the Chief Investment Officer. Shh, this is the panel now, okay? All right. He's the Chief Investment Officer of the $145 billion California State Teachers Retirement System, CalSTRS. He's Governor of International Corporate Governance. He's a member of the Pacific Pension Institute, Chairman of the Milken Institute's Global Capital and Markets Advisory Council, which is composed of senior leadership of about, I think it's $16 trillion of assets under management. And he is a great friend, a great moderator, and someone we're delighted to have on hosting this panel. So Chris, panelists, all yours.
Thank you very much. Thank you, everybody, for coming. I know your interest is on our panel and on Europe, maybe the speaker after us, I assume, with the president coming in. And so thank you for your attention. Please enjoy your food. What I wanted to do is first introduce the panel briefly. Their bios are in the booklets that you received. But first, Dr. Roubini, who, if you were in his discussion earlier when Michael Milken interviewed him just one panel before this, I know that room was absolutely packed. He's chairman of the rather cleverly named Roubini Global Economics, a professor of economics at New York Stern University, and has been an advisor to the U.S. Treasury, the International Monetary Fund, and to the World Bank, and the author of over 70 articles and books, and that's probably understated, I would bet. Josef Stadler is the group managing director and global head of ultra high net worth at high net worth asset management at UBS. I've often asked him, it would just be nice to reach high net worth, but then ultra high net worth. But he is responsible for over $350 billion of ultra high net worth assets. And I'm sure your friends list is a lot better than mine. So, next to me is Ray McDaniel. Ray is chairman and CEO of Moody's, the rating agency. He climbed through the ranks at Moody's and actually started there as a senior analyst in New York. So you have been through, I'm sure, all the facets at the firm. And then lastly, on my right is Jason Cummins. Jason is the chief U.S. economist and head of research at Brevan Howard. Brevan Howard is one of the largest global hedge funds with over $32 billion in assets. He, in the past, was a senior economist at the Federal Reserve, where he also ran the macro forecast. Now, our panel is about Europe. You have heard a lot already about Europe, but our goal is to not depress you, but hopefully have an uplifting discussion about the realistic situation that confronts us with Europe, and what are some of the optimistic things we could find about it, but also realistically, what is a little bit about the future. And I'm actually going to start with Dr. Roubini, since you had an earlier discussion. What are your perspective for Europe at this point?
Well, I'm very concerned about specifically the eurozone. And of course, within the eurozone, there is a group that is the core, that is economically and financially in better shape. And then you have a group of countries, I would say 6, Greece, Ireland, Portugal, Italy, Spain, and Cyprus, that have severe economic, fiscal, and financial problems. First problem is that there is a stock imbalances with large stocks of public and private debts. Private of the household sector, of the financial system, of even the non-financial corporate sector in places like Portugal, Greece, Spain, and so on. There are flow problems because you have lack of economic growth, and actually a recession is becoming more severe. Today's PMI suggestion, the recession in the periphery of eurozone is becoming almost like a stagnation. So you have a recession, lack and loss of competitiveness, as unit labor costs rose more than 40% in the last decade, and you have now large external current account deficits that the private sector doesn't want to finance. So you have stock problems, you have flow problems, you have liquidity problems because you have refinancing needs both for the governments and for the banking system. The refinancing needs of the banking system have been, how to say, backstopped by the European Central Bank. It has played the role of a lender of last resort for the banks through the LTROs. But there is nothing equivalent to a lender of last resort for the sovereigns because the institutional constraints of the European Central Banks do not allow it to do a full monetization of public debt. So there is the refinancing risk of the sovereigns. There's a process of balkanization of the banking system in Europe as the foreign creditors roll off their claims, and increasingly are relying on ECB and the Target 2 balances to backstop the banks and the LTROs. There's a process of domestication of public debt as there is a roll-off of the exposure of the foreign creditors, and the link between sovereign risk and the banking risk is becoming even more tight. Sovereign risk because of the large public debt, banking risk because of the financial, capital, and equity and liquidity problems of the banks viciously interacting with each other. And this recession in the eurozone is becoming worse. It's becoming worse because the fiscal austerity, however necessary, leads to more recession as you raise taxes and cut spending, because the euro is too strong. Germany is uber competitive. You can live with a euro at 1.3. For the periphery, the euro should be at parity, if not lower. You have a credit crunch in the periphery because of the capital problem of the banks that are selling assets, contracting credit. Oil prices are high. It's a bigger problem for the eurozone. At least in the US, half of our domestic consumption is satisfied by domestic production, not the case in the eurozone. And now there is increasing political and policy risk in the eurozone because there is reform fatigue and austerity fatigue in the periphery. You see it in the Greek election where the parties in favor of default or exit could get 50% of the vote. You see it with maybe Hollande being now elected in France. You see it with austerity fatigue in Italy and Spain. You see it with the Irish potentially voting against the fiscal austerity. And in the core, instead of austerity fatigue, there is bailout fatigue, because rounds and rounds of bailouts have not led to a stabilization of the periphery, and eventually the credit risk that Germany and the core is taking could become significant. And therefore, this divergence between austerity fatigue on one side and bailout fatigue on the other side in the core could lead to something that is unstable. What's the conclusion? My view is that Greece is not going to be the only country. It's going to be forced to restructure its debt in a coercive way. It's going to happen, like in Greece, in several of the other members of the Eurozone. And Greece is going to be the first country by late next year is going to formally exit the Eurozone and go back to its own national currency. It's not going to be the only one. Now, if a small country like Greece or Portugal exits, you could have an orderly divorce. But if that restructurings and or exit were to hit either Italy and or Spain, that are the third and the fourth largest member of the Eurozone, effectively you could get the breakup of the Eurozone. Now, I don't see that happen in the next 12 months, but over the horizon of the next few years, I would not rule out that one as being a scenario that could materialize, depending on the policy reactions.
But in a way, that's good. I mean, you're not predicting death and destruction and the end of life as we know it.
Well, not that, but yesterday I wrote a note to the clients of my firm that was titled 12 Drivers of a Slow Motion Train Wreck in the Eurozone. So it's a slow motion train wreck, maybe it's a death by 1,000 cuts as opposed to a sudden collapse and heart attack and death, but it's a slow motion train wreck, and things are going to get worse rather than getting better.
I feel so much better.
It's not an optimistic outlook.
Can I have somebody's dessert? Because I need some... I told him I would tease him a little bit on that. Jason, you see the world differently.
No, actually, I'm going to argue for the end of life on Earth as we know it. So I'm going to
So
pick the other side.
Aztec calendar, we're going to hit that, what is it, December 12th? It's all over, right?
That's right. I think the Mayan calendar.
Mayan calendar, not Aztec, pardon me. Thank you for correcting.
So let me take a counterpoint, but not on the end of the world. Let me try and provide a maybe more constructive perspective, even though I agree with Nouriel on most of his major points. I want to talk about two things. I want to talk about policy, and I want to talk about Europe's role in the world. On the policy side, I think the important thing to realize is that policymakers are engaged in the same discussion that we're having here today. They listen to us, and I think that the most important thing to understand about what's going on in Europe is that there are policymakers with different intentions, but you have to respect that they have genuinely thoughtful interests in going forward in a constructive fashion. It has been a bad idea to bet against policymakers ever since the fall of Lehman. You had the dream team in the US conducting our policy bailouts and then fostering the conditions so that we could recover. In Europe, what have we seen? We've seen that Greece was going to default, and that was going to be a tragedy. Greece defaulted. We're still here. It's not the end of life on Earth as we know it. The European banks were not going to be funded as of the first quarter of this year. There were some LTROs, and the European banks have now made it through. Maybe they'll need some more LTROs. Maybe there's some more policy optionality that has to be deployed. But I think the key thing to understand is that when we're having this conversation, you need to understand that policymakers are also having the conversation. And we need to assume best intentions about what they're doing at the same time. Now, it's not always the case in a union with either dysfunctional or immature institutions that they can work magic. But I think that over the coming years, we should be prepared for the idea that policymakers will eventually do the right thing. It won't always be a smooth path to doing the right thing. And after all, in the US, we have a 200-year history of institutions. And as I said, we had the dream team of policymakers, and it still took us a couple of years to do these things. So I wouldn't be prepared to say that this is all going to be resolved by this summer or next summer, but at least there is a conception ahead where Europe is going, even if there isn't a plan. So on the policy side, the way I'd summarize things is that policymakers hear this conversation and they're actively engaged in trying to help the situation. The other thing I'd say is just to, especially from my perspective in the US, is contextualize this. And since we're at the global conference, I'd also want to contextualize this outside of Europe. So I'm going to tell you a couple different things. The first thing is the growth in the world since 2007 has been about 3% per annum, a bit better. In that time, Europe has contributed exactly nothing on average. So we can all grow without Europe. It's not a place that we need to see the same kind of dynamism that we've seen in the past. It's possible that even though 90% of the headlines are about Europe, we'll be able to go forward and do a lot of the things that we've been talking about in the global conference without having it affect us. The second thing is, when I think about how Europe affects the US, I have two, this is the bad news, equally unsatisfactory ways to think about it. By background, I'm an economist, and what I know from the economic models, whether they're our own or the Fed's or the ECB's, when you run these models, you find that whatever bad happens in Europe, it doesn't have that big of an effect in the US. The spillovers aren't that great. The spillovers, of course, are greater in areas that are proximate to Europe and close trading partners like the UK. But so far as the US is concerned, when you ask an economist what's the effect of a European problem, they say, it's a few tenths on GDP growth. That doesn't match up with your kind of casual empiricism. After all, we have a room here filled with hundreds of people, and it wouldn't be filled with hundreds of people if we thought that Europe was less relevant along the lines that the model suggests. So that's unsatisfactory in some sense. The other unsatisfactory bit for contextualizing Europe in a broader context is your own casual empiricism. And I go back to 1998, when you had a rolling series of financial crises. If you would read the headlines of the FT or the Wall Street Journal, you would have said, this is the most traumatic and awful years in the post-war. And indeed, President McDonough of the New York Fed in September of 1998 said, we're going through the worst financial crisis in the post-war period. Would that he had seen forward. But we were going through something traumatic then. And if you looked at what actually happened in the US economy and in other economies, it looked pretty good. US growth was over 4%, the unemployment rate was hitting new lows, inflation was falling instead of rising. So you need to be very cautious about applying that casual empiricism, because sometimes you won't even get the sign of the effects right. So this is not to say that Nouriel's wrong about anything, but I think we need to be enormously circumspect about figuring out the effects on other areas and selling short the policymakers' option for trying to address exactly what we're worried about here.
I appreciate your clarifying that Nouriel's wrong, because I didn't want to have to, get in a fight up here. So, Joe, what's the perspective of high net worth individuals?
So, when you're talking about billionaires in APAC, and ask them what they think about dollar and the euro, they say it's a choice between the plague and cholera. What I mean with that is the following. If we're honest to ourselves, what happened in the United States since the financial crisis hit it? The United States did three things. First, they didn't save a penny. Second, they cut their interest rates to the bone. And third, via Operation Twist, they're massaging the long-term rate. Europe tries to shrink itself to greatness. Obviously, it doesn't work. So if you look at the end game, what Europe will face if they austere themselves to death, there will be negative growth in the southern belt, including Italy, Spain, Portugal. There will be solvency issues, etc., etc. So the way to go for Europe is basically to copy-paste the American way, which is printing money, getting inflation into place, and letting the euro crater. The euro, in various analyses, is probably 15 to 20% too high, and the reason why it hasn't actually gone down, given the crisis, is that large European banks who have a major share in trade finance, also in APAC, are repatriating funds into euro. But the fall of the euro is inevitable because traditionally, if we are honest to ourselves, the way Italy, Spain, Portugal, France, and Germany managed to get themselves out of the abyss in previous recessions was they basically let their own currency float. Now, the whole southern belt in Europe is not able to do so. And that's the way to go. One last thing on the rates. If you're looking at Germany today, the status quo is paradise. They have restructured, they have increased efficiency between 2000 and 2005, and now with the euro having dropped slightly, 15 to 20% from their trade-weighted average, they are exporting themselves into nirvana. They're running at fullest capacity. The southern belt is the opposite. Italy is not able to export themselves into nirvana simply because the euro is still too high. And that creates solvency problems going forward. What will happen most probably, that's my personal end game, is the eurozone will not fall apart. That's wishful thinking from a lot of people. There may 2 or 3 countries may leave the eurozone, but not the entire 17. But ultimately, the end game could be that the governments who have to say, France and Germany, will pull themselves together and agree to do Eurobonds together, which means higher rates for the northern belt and lower rates for the southern belt.
Now, Ray, on Sunday, we heard a really great, at least I felt it was a really good word picture, that the euro was basically the idea of a young couple that are engaged, deciding to have a joint checking account, and then they decide to invite in their in-laws and allow them to be in the account, deposit money, withdraw money. Everything works out pretty well. But then they bring in the cousins and the second cousins, and some of them don't deposit money as well. They mostly write the checks. So I'm going to bring you back to the original couple, which I assume in this analogy is Germany and France. Germany has benefited from this relationship, but talk to us about France and their AAA rating. Where do they sit?
Well, France has the weakest government debt metrics of the AAAs in Europe. We currently have a AAA rating with a negative outlook on the government debt. And I think that the consequence of that, if they are going to maintain a AAA, is that progress on fiscal consolidation is going to have to occur under any government, and that's going to have to be a priority. Now, there may be reasons why they move at a pace or in a direction that is not consistent with the AAA, and that's why the negative outlook has been assigned. But the mandate, the demand for progress on fiscal consolidation and improvement in those debt metrics is going to be on the table, I think, for any government.
Now, Jason, you brought up the point that they can, in essence, kick the can down the road using more fiscal and monetary effects. Doesn't the can get too big at some point that it can crush them?
Absolutely. I don't think anyone in this room would have a different conception that the U.S. and Japan and Europe are going to be engaged in a long and complicated conversation about how to allocate these resources and how to do it. In our own country, we're worrying about the fiscal cliff next year. So it's not as if this is unique to Europe. What's unique to Europe is lack of institutions and lack of having dealt with these things in the past. The US had a debt crisis, and it was in the 19th century. So these things are old news to us, but they're new for Europe. And I was just thinking about your analogy that you took from Sunday about a young couple. I actually would use a different analogy, which is Europe is an old couple. It's a couple that's been together for 60 years, and they've had fights every year about all kinds of things. And if you come in and look at that couple as an outsider, you'd say, oh my God, this is the most dysfunctional, bickering couple I've ever seen in my entire life. 60 years, I don't even want to be in their house. And in fact, they have such long memories of all these issues. They're arguing now in France about having a growth pact. Well, this goes back to, in the 1990s, the Growth and Stability Pact. It started out as a stability pact. It ended up as a growth and stability pact. We have a new stability pact. It's probably going to end up as a new growth and stability pact Mark II. So all these things have hints of past discussions in the euro area. So in a way, there's a bit of that intellectual muscle memory there in this couple. And the idea that, for me personally, the idea that Europe and France, this couple that's been together for 60 years successfully, is going to blow up or jettison this project is just not something that's been borne out by history.
Nouriel, you have a comment? The one thing I
Well,
would add is I'm fascinated by how we look at this as an absolute crisis, but the perspective across the pond is they're shocked that Americans seem so worried about it, that they're comfortable with their situation and they'll work through it.
Well, I mean, you pointed out that so far the Europeans have tried to kick the can down the road, this approach of muddle through, extend and pretend, pray and delay, pretending that every problem is a problem of liquidity rather than one of solvency. So you start with private debts, they become unsustainable. Then those private claims were essentially backstopped by the sovereign. So we went from private debt to sovereign debt. Then when a bunch of these sovereign lost market access, Greece, Ireland, Portugal, and so on, soon enough probably Spain, we decided to use supranational or super sovereign to bail out the sovereign. So we have gone from private debt to public debt to supranational debt. But you cannot keep on kicking the can down the road because nobody's going to come from the moon or Mars to bail out the IMF or the EFSF or ESM or ECB. If the problems are problems of solvency, eventually orderly debt restructuring have to occur. So the way I see the Eurozone right now is that the current model through is not a stable equilibrium. It's not even a stable disequilibrium. It's an unstable disequilibrium. So either the Europeans are going to move in the direction of one, following a series of policies that restore growth, restore competitiveness, restore external balance, that stabilize and reduce debts, and that implies over time having not just a monetary union, but a fiscal union, fiscal risk-sharing, debt mutualization, and that implies also a political union, because historically there hasn't been a single historical cases of a monetary union that has been successful without eventually a fiscal, financial, and political union. So either you're going forward, and I think there's going to be significant political resistance of doing that, or otherwise this is going to be a process not of integration and union, but of disintegration that gradually over time is going to lead to more countries restructuring their debts, orderly or disorderly, more countries essentially exiting the Eurozone. I agree, if a couple of them exit the Eurozone, as I pointed out, the Eurozone survives. But if Italy and Spain, the third and fourth largest, exit, that's a breakup effectively of the Eurozone. So it's a critical thing. You cannot maintain muddle through. You have to move in one direction. In the direction of further full integration, I don't think that politically is going to be likely. So it's a political decision as much as anything else by Germany and by the core.
So let me ask all of you, is it kind of door number one where it's going to be integration? They're going to come together and come out stronger. Door number two, disintegration, somebody's going to have to leave. Or we'll leave door number three open, which is going to be muddle along. Joseph?
I think the key doesn't lie in Washington nor in Beijing. This time it lies in Berlin. If the Germans agree to inflate the economy for the price of getting more influence, I think this is half of the party. And if you look around in Europe, I think more and more countries are trying to understand that this trade-off needs to be happening. So I'm very optimistic. Not necessarily that Berlin will then sort of have a more dominant say in the whole universe of Europe, but basically that there will be a solution. So quite on the optimistic side.
You're door number one, disintegration.
Yeah, I'm not optimistic for the following reason. So far, the adjustment in the eurozone has been asymmetric. The core has told the periphery overspend, you have to spend less, you have to save more, you have to do fiscal austerity, you have to do structural reform. And while these things are necessary, in the short run, they are recessionary. And this recession is becoming a depression. Unemployment rate in Spain and Greece is almost 25%, almost 50% among the young people. So that line is going to lead to a situation that leads to a deflationary recession. What you need to do, I don't think that politically it's easy or acceptable for Germany. You have to have less fiscal austerity in the core, or even a fiscal stimulus in some countries. You need to have a fiscal stimulus in the core of the eurozone, and the Germans say, no way. You need to have a more symmetric adjustment where the core saves less and spends more, so that as you have a current account deficit shrinking in the periphery, you have a surplus of the core shrinking as well. You need to have massive monetization of this public debt by the ECB, and the ECB says, I have a single mandate that is only inflation, not even about growth. I legally cannot monetize these deficits. You need eventually to have a fiscal union with fiscal risk sharing. You have to have debt mutualization. That means that some of the credit risk of the periphery is taken by the core and Germany, and you have to have gradually, with this easy monetary and fiscal policy and a 30% devaluation of the euro, then having gradual inflation rising in Germany in the core, while it remains lower in the periphery, so that the relative price adjustment restores the competitiveness of the periphery. Now, I would ask you, what is the chances that the ECB, the Germans, and the core are going to accept fiscal stimulus, massive monetary easing, 30% fall of the euro, debt mutualization, and less fiscal austerity in the periphery? I would say is a very low probability. And that's why I fear that eventually that's going to lead to a train wreck that hits something.
That's when you're optimistic.
Can I quickly respond to that? I fully agree with what you say. The only problem is that there is a dilemma. The cost of failure should not be bigger than the cost of non-failure. So the German chancellor will sit down and say, what does it cost me, option A or option B? She is as a cold-blooded investor as many of you in this room. She will take a decision. And I'm not sure that she will take the wrong decision.
Well, but you have the German chancellor, but you have the German voter and the voter in Finland, in Austria, in Netherlands, and those voters are saying, the Greeks had a big fat Greek wedding for the last 20 years, not for a weekend. We gave them bailout number one, we gave them bailout number two, we gave them a 75% reduction of their debt, we got losses, and they're not doing any fiscal effort, so enough is enough, and at some point we should put the plug and let them exit, because we don't want to bail them out forever, and we don't want to take the credit risk of backstopping not just 200 or 300 billion of Greek public debt, but Italy is 1.9 trillion. Spain is 900 billion, so the Italian and Spanish debt is almost 3 trillion. And if you're going to have debt mutualization, the German taxpayer monies are now backstopping their own debt through their own taxes, are going to backstop also the debt of the periphery. That's why there is political resistance. So there is a cost, actually, of continuing along the current path, and increasingly the voters, if not the policymakers, are saying, I'm not convinced that's the right solution.
Chris?
Yeah, I was going to
Can I
go
just
here.
jump in?
Integration,
Can I just jump in?
disintegration.
So I think Nouriel and Joe are both right. And you asked the question, which of the three doors? And the three doors were further integration, disintegration, or the possibility of disintegration, and third, muddle through. I think if you take the intersection of what Nouriel and Joe were saying, you get my answer, which is we're going to walk through all three of those doors. We're going to be walking through all three of those doors in a very long, complicated conversation that's going to be difficult for people. We'll probably have the same panel next year going over some of the same issues, and it may be that another country defaulted, just like Greece has already defaulted, and it's not the end of the world, and we'll be talking about the Germans and the French having this 60-year conversation since the European Coal and Steel Union of further integration. You'll be having the conversation of, geez, the Greeks did have a big fat Greek wedding and maybe they shouldn't be in the eurozone. And finally, you're going to be having the conversation of, well, you know, perhaps growth isn't going to be particularly dynamic in this environment. We are going to muddle through, and we don't have lots of dynamic institutions that have 200-year history, so we won't necessarily be able to deal with these problems as well as we otherwise would be able to do. So my answer is all three doors for probably more than 3 years.
Ray?
You know, we quite understandably talk about this as a crisis, but it may be constructive to think about this as an evolutionary process. And we happen to be in a period where that evolution is particularly painful and quite messy. And we are going to have to see rapid adaptation. I think one way or the other. I don't think there is a third door. I think that we're at a point where the adaptation is going to move us in the direction of integration, or defaults and exits and more disorderly disintegration. But that the middle path is really not available at this point.
What about, so exit? We've talked about Greece defaulting. It could handle Portugal. But obviously the big question is going to be Italy and Spain. Are we going to reach a point where there's open talk about them leaving the euro? And is that going to happen? As Jason said, we're going to have the same panel a year from now. When is this going to occur?
Well, Greece, Ireland, and Portugal have already lost market access. They required external bailout, and one of them has already gone through the path of debt restructuring, and Greece may also exit, in my view, in the next 18 months. Portugal and Ireland may require debt restructuring. Ireland is more competitive, might be able to stay in the eurozone. I'm not sure about Portugal, but these are small countries. So the big elephants in the room are, of course, Spain and Italy, and today Spain is more at risk than Italy, because you had a huge credit and housing bubble has gone bust. Unemployment rate is 24.4 at the national level, 50% among the young. The banks are in trouble. The economic contraction is becoming more severe. Their PMIs are in the low 40s. And there's a risk they're going to lose market access. Now, if they lose market access, I think that it's going to be always the same kind of path. First, you do plan A. That means let's pretend they are illiquid, give them a big IMF package together with the ESM and see if they restore market access. If things improve, that there is a chance, but things may actually get worse. And by the way, once you get official money, the private creditors become subordinated, because in the pecking order of the capital structure, IMF money is more senior, ESM money is more senior, and even things that were supposed to be pari passu, like ECB claims, are becoming senior, and the private creditors, like in Greece, were subordinated. So if you're a creditor of this country, you're saying as soon as there's an IMF program, the spreads are going to widen rather than narrow, because the probability that in a default or restructuring, I'm going to be treated first is much higher. So spreads widen, then the economic contraction becomes worse. Then plan A doesn't work. If plan A doesn't work for Spain, they're going to decide whether they want to double down and do plan B, or if they don't do that, they'll have to go 2 or 3 years from now to a debt restructuring. That restructuring can resolve their debt problem, but unless you restore growth, competitiveness, and external balance through a real depreciation, eventually you might end up with an exit. But take Spain, they've not yet lost market access, so if you think about this slow motion train wreck, you get restructure maybe 2 or 3 years down the line and exit 4 years down the line. So it's not something that's going to happen in the next 12 months. And each one of these countries could be in different parts of this slow motion train wreck.
It's going to happen in our lifetime.
I'm not saying that the eurozone is going to break up. My view is several countries will orderly restructure their public debts and private debts. Some of the smaller ones are going to exit the eurozone. As I pointed out, the eurozone survives if you can eventually restore the sustainability and the growth of Italy and Spain. If Italy and or Spain exit, then effectively, yes, the core of the eurozone is going to stick together. Say, Germany and Netherlands and Austria and Finland. There's a question mark of whether France is going to be part of that core. Increasingly looks like it might become part of the periphery, but effectively you have a breakup of the eurozone if you have only 6 or 7 countries left and everybody else has exited.
I was going to ask, Josef, you said Berlin is the center. It's up to the Germans. But what about the French? Are they on the periphery? The outcome of the election, is that going to change things dramatically?
No, because both governments have no choice. Let me just follow up on what Nouriel said. I think Spain is hardly manageable, but it's probably manageable. Where the buck stops is Italy. It's one of the biggest bond markets on the planet. Luckily for the Italians, most of the government debt is held by Italians. The problem is, if Italy leaves, then the German-dominated northern belt, with Germany at the epicenter, that currency would skyrocket. And then you would have the same challenge as the Swiss National Bank has these days, with a currency that is going ballistic, basically destroying the export capabilities of Germany and of all the other countries in the north. So it's in the fundamental interest of Germany that Italy doesn't leave. One point on France. France is probably more vulnerable than Italy simply because of the fact that more government debt is held by foreigners. So I'm saying that if Italy is leaving the European Union, the whole thing is falling apart. So the rest of the Union will do everything to prevent that from happening.
What about the citizens? I mean, it's one thing to default to the creditors, but right now they're really defaulting to the citizens by changing the social pact, changing the arrangements they had. You brought up the 25% unemployment, 50% in youth. That's not a healthy balance. Last time I knew that many young people without a job, they're usually up to no good. How do they work through, as you said, how do they find solutions in that kind of a situation?
I think the point I'm trying to make is we don't know. We really don't know, and they have to have that conversation. That's what these elections are about. In our country, our next election is also about how to balance taxes and spending. But the thing I'd say is these aren't unfamiliar conversations. France has elections every 5 years. They have this conversation every 5 years. A right-wing candidate was the candidate instead of the socialist candidate 5 years ago in France. The world didn't end. You know, so we've seen riots, we've seen social disintegration. I'm not saying it couldn't get worse, but I'm also not saying this isn't something that we haven't seen before or dealt with before. So I don't have a good answer, but the conversation's ongoing.
Well, go ahead.
I think part of the problem in the Eurozone right now is there is an austerity strategy, but there is not a growth strategy.
Exactly.
And economic growth not only is not positive, but it's becoming increasingly negative. And unless you restore economic growth, not 5 years down the line through structural reform, but in the next 12 months, you'll have two problems. One is that people are willing to tighten their belts as long as they see light at the end of the tunnel. But if there is not going to be any recovery of jobs, of income, of growth in the next 12 months, eventually the social and political backlash against the austerity, strikes, demonstrations, riots, weak governments, collapsing is going to become eventually overwhelming. Secondly, you're trying to stabilize debt and deficits as a share of GDP. If the denominator's GDP keeps on falling, you can try to do as much effort as you like on the numerator, but those debt ratios are going to explode, and the market is going to say these countries are unsustainable. So until yesterday, the market were telling these countries, cut your budget deficit, primary surplus, balanced budget amendment, and grudgingly, this new government have been trying to do these things. But in the meanwhile, the recession has become worse, and now the market's investor woken up and said, kids, good effort on the fiscal side, but guess what? Your output is in free fall, and you look like insolvent like before. And therefore, unless you restore growth, eventually this strategy of just austerity and not think about growth is going to be unsustainable. That's why you have to jumpstart growth. But to jumpstart growth, you need a weaker euro, massive monetary easing by the ECB, stronger inflation in the core, fiscal stimulus in the core, and less front-loaded fiscal austerity in the periphery. Those things, in my view, are not happening. That's why I worry about what's going to happen.
But how do you really feel? Ray, it looks like, if this keeps carrying on, we already solved Milken's problem. We can tell them they can have this panel every year for the next year, although I think you'll get tired of it. But everybody's going to focus in on ratings. I mean, just like we saw yesterday, another rating agency, I don't remember their initials or something. The minute you downgrade somebody, everybody's going to be focused on you, and that's going to be a market mover. How do you factor that in?
Well, the ratings, clearly there are severe credit pressures in Europe. A majority of the members of the eurozone have negative outlooks on their government debt ratings. But even with all of that, the rating agencies have been far more moderate in their outlook than market-based signals, whether it's credit default swaps or secondary market bond pricing. And so the consequences of rating actions at this point, I think, really tie back to more how the ratings get used mechanistically, as opposed to saying something that is inconsistent or moving in a direction that's inconsistent with market sentiment. There are consequences to rating actions that are not consistent with other opinion providers. And that's where the tension comes in. But we can't forbear. We have to take whatever actions we think are appropriate. And it's up to policymakers to make sure that the consequence of speaking is not much larger than the indication of change in risk that's associated with a rating action.
Yeah.
Nouriel's got a question.
Ray, I have a question for you. If you take the Greek debt restructuring, I think we've learned a few things. First of all, debt that is based on domestic law can be restructured much more easily than that is in a foreign jurisdiction. Secondly, that even if you don't have collective action clauses, you can retroactively introduce them and make it easier to restructure. Three, that stuff that was supposed to be pari passu is not anymore pari passu. There's been effective subordination of some of the private claims to official claims. Four, that the investor base thought that this debt was subject only to interest rate risk and now is subject to credit risk, and they're not used and comfortable with it. And finally, there is this vicious interaction between sovereign risk and banking risk, because if you socialize the private losses like Ireland has done or as Spain could do, then the implicit and explicit public debt becomes bigger than otherwise. So how do all these factors affect the way you perceive ratings and credit risk for some of these Eurozone sovereigns? You have to rethink about this stuff? Or
Well,
not?
absolutely. And in effect, what you're introducing is what kind of capital tiering is going to be in place in the future. And that is, and there are lessons to be learned from situations like Greece, where you can see that both policy actions inside the country and policy actions at a pan-European level may alter the capital priority and repayment priorities, and those have to be factored into the ratings. At a minimum, it's introducing uncertainty, and uncertainty introduces risk.
Do ultra high net worth individuals, do they track the ratings? Does that materially impact their investment decisions?
Not really. No longer. No, what they're doing, a very good question you ask. Given what we've said right now and this race to inflate each other's countries, we may end up in a situation where we are in a World Series of printing. He or she wins who prints fastest. Sort of reminds me of three individuals jumping out of the 50th floor of the Empire State Building. No parachute, of course, competing who is fast, who is down fastest. On the floor, there's this parking lot made of concrete. And my investors, what they do, they look at this scenario and say, probably time to buy real assets. Real estate, precious metal, non-bankable.
Are they buying those in, particularly the real estate, in Europe or outside of the European
In Europe, outside of Europe. German real estate prices have gone up significantly. Many Chinese are now buying cross-border in the United States, into Latin America, Russians buying in Southern Europe right now. So the hunt for real assets is really on.
So a shift from intangible to tangible assets across the globe.
Correct. I'll give you another data point. In the first 6 months of 2011, I don't like to give you numbers because people tend to forget them instantly, but I think it's significant enough. In the first 6 months of 2011, the consolidated net new bankable assets that were flowing into the big money center bank, including JP Morgan, UBS, BNP, HSBC, what have you, globally, added up to about $100 billion US. In the second half of 2011, that number was down to 4. A clear trend outside of the banks into real assets.
Chris, just one thing. Brevan Howard also qualifies as a real asset, just...
Okay. Well, I was going to put it back to you. Does Brevan Howard make all its investment decisions based on rating agencies?
I think rating agencies are definitely input to how we think about the world. I think the heterogeneity in the ratings has been difficult for us to understand when U.S. banks, for example, which are highly capitalized and have dealt with their issues enormously well, share similar ratings around the world to some other banks. I find that confusing. So we use those as an input, but oftentimes we're a little unsure about exactly what the constellation of ratings means in this environment.
Well, I mean, speaking of high net worth individuals, I think that one of the consequences of what's happening right now in terms of capital flight from the periphery to core of the eurozone is take the banks. The cross-border stuff rolled off, the interbank stuff rolled off, the wholesale funding rolled off. Anything that was big deposits that are not insured, that were the high net worth individuals, have been rolled off. So there's been a silent run on the banks in Greece, in Portugal, now starting even in the case of Spain. Until now, you have not had a run on the deposits because the average depositor, there is not a rich guy, thinks my deposits are safe because there is deposit insurance. But think, if we get to the point in which people realize that there may be an exit, and if there is going to be an exit, like in Argentina, they'll have to impose deposit freezes because otherwise you have a bank run, and that your euro deposits in your Greek bank is not the same thing as a euro deposit in a German bank, because if there's going to be exit, of course, all the liabilities have to be converted from euro into new depreciated drachma. At that point, you could even have a run by the smaller depositors, because you are subject both to liquidity risk of being frozen in the bank and forced conversion, there is a form of default, of your euro claims into depreciated drachma claims. So it's a slow motion kind of run. It has already been hitting those who are smart enough and the smart money, but eventually it could go beyond that. That's one of the risks we're facing.
Ray, you were going to make a comment?
No, I was just going to say, I actually think that Brevan Howard's attitude toward the use of ratings is very healthy. I think we are most comfortable when the ratings are an input, a part of the conversation about credit risk and credit worthiness. But we should not be the source that ends that conversation about creditworthiness. We should be an input to a wider conversation. And that's, it's one of the concerns we have with the appropriation of ratings for use in regulation is that it tends to stop the conversation because there are automatic consequences for a rating action.
Yep. Now, you mentioned you expected a decline, a devaluation in the euro. I want to ask all of you, is that going to happen? And if so, when? As you pointed out articulately, the euro's been supported. We've assumed it would fall. People have bet against it, yet it hasn't.
I don't have a clue. I think it would depend upon what you're seeing happening. You can imagine scenarios that make the euro appreciate, as both Nouriel and Joe described. You can think of ones where it depreciates. It's not knowable at this point.
So a year from now, when we're back here in this ballroom in April, 1st of May, euro's around 130 or is it around 60?
Tell me what's happened in the interim in terms of policy and growth and so on. We're just humble investment managers.
Oh, humble. So I don't need to pay you that 2 and 20. I'm going to quote you on that.
I think it's 2.5, Chris.
2.5. Yeah, it just went up.
Well, the euro has to fall, but there's this puzzle rise and fallen. One explanation can be repatriation of trade finance from Asia. In part is because Germany is strong, runs a trade surplus like the core of the eurozone, while the periphery has a deficit. It depends on relative monetary policies. The ECB has done some monetary easing, but the Fed has done QE1, QE2, Operation Twist, might do QE3. Therefore, relative money supplies matter. And by the way, unfortunately, we live in a world in which the eurozone needs a much weaker euro to restore the growth of the periphery because domestic demand is collapsing because of the deleveraging. But the US needs a weaker dollar because domestic demand is weak because of private and public sector deleveraging. So the US needs a weaker dollar to restore its export competitiveness and growth. And the UK needs a weaker pound, and the Japanese need a weaker yen because domestic demand is weak in Japan. And in China, they want to maintain their export-led growth, so they aggressively intervene to prevent the Chinese currency from appreciating, and everybody else in emerging Asia and Latin America says, if the Chinese don't move, I don't want to let my currency undervalued to appreciate because otherwise I'm going to lose market shares to China. So the reality is it's a zero-sum game because if my currency is weaker, somebody else has to be stronger. If my trade balance is better, somebody else's trade balance has to be worse, right? the sum of all trade balances in the world is equal to 0, as we don't trade with the moon or Mars. So it's a zero-sum game in currencies, it's a zero-sum game in trade balances, and eventually currency tensions can lead to currency wars, and currency wars can lead to trade wars. We live in a world in which, for structural or cyclical reasons, domestic demand in most parts of the world is not strong, and everybody wants to have growth through net exports, and that's why it doesn't add up. Now, I was in Washington, I said, suppose you want to save the eurozone, and suppose the euro falls from 1.3 to 1 relative to the US dollar. I asked people at Treasury and the White House, how would you feel about it? They said, even if it goes to 1 to 1, we'll take a hit, let alone if it takes to parity, because of course the US, with 30% weakening of the euro, is going to have a problem with its growth, and maybe a double dip. Same thing in China. If the Chinese currency were to appreciate by 30% relative to the euro, since they are sharding US dollar, you'll have a growth problem in China. So the way you resolve this conundrum is that if the periphery deficits have to shrink, the surplus of the core also have to shrink, but that implies that Germany has to stimulate its own economy. Otherwise, you're going to transfer your problem in a beggar-than-neighbor way to the rest of the world in ways that's not acceptable for US or Chinese growth. The adjustment has to occur within the eurozone, and it's not occurring.
You took us from disintegration of Europe to a trade war. I'm worried about going longer. Joseph, you had a comment?
I try and answer. I fully agree with what you said. It depends. I hate that. It depends, but it really depends. If the US is falling into a recession next year, the fall against the euro, so the euro fall against the US dollar will be slower. It may be 120. If the US is getting stronger, I think it may go down to 110 or so.
Last question. A year from now, how many countries, let's say 2 years from now, this is obviously a very slow-moving train wreck. There are 17 countries in the euro. What would be your guess on how many are actually left in the euro 2 years from now? 17, some number less.
Probably 17.
This was where I told you
Yes,
earlier.
there were limits.
You might ask a question that I don't choose to answer. I'm going to make it this one.
You can pass. How many countries are left?
Well, before you exit, the question is how many countries have to restructure their public debt. Greece has done it. I think Portugal is another case that is going to lead to an orderly debt restructuring. I think that even Ireland needs some reduction of its debt burden because they've socialized the losses. And I would say, the first one to exit is going to be by the end of next year, Greece. I think, unfortunately, even Portugal, is going to eventually have to exit. I don't think that Ireland is more competitive, will exit. And then the question remains of what happens to the big elephants in the room. And I think it's going to be more of a slow motion, because if things go wrong in Spain and Italy, the first reaction is going to be bail them out, provide them liquidity, and hope that you resolve the problem. But I think that between Spain and Italy right now, I worry more about Spain than about Italy. I think that there are structural problems in Spain that are even more severe than those in Italy. In Italy, the public debt is twice as high as the one of Spain, but the one of Spain is rising very sharply. And you have the housing bust, you have the credit problems, you have the banks, you have the high unemployment rate, you have the loss of competitiveness. So I do worry about Spain. I think at this point, people don't care as much about Greece and Portugal, where it's granted things could go in the wrong direction. The big issue is, does Spain lose market access and eventually goes in a path that is similar to the one of Greece? I think it's an open question.
16, 17 minus Greece. I don't think it makes any sense for Ireland to leave. There's nothing to gain. So 16, yeah.
And is the euro stronger at that point?
No, weaker.
So I think we learned a couple of things. One, and I know Bloomberg's here and CNBC and a few others. My staff told me that Bloomberg was responding to comments made live here, and they were seeing it on the screen. Hopefully one that will go out and stay forever is that Brevan Howard is humble. I think that's rather profound. But as I feared, we've got a slow-moving train wreck. I think we made it perfectly clear they're going to go through door 1, 2, and 3. They're going to come together, but then also break apart, and that this is going to last for quite a few years, hopefully not 60. But I guess I took from your comment, this is kind of like the Bickersons.
Bickersons, yeah.
And I know that was quite popular, but I've tried to listen to that show a couple of times, and it just drives me nuts. So is the focus only going to be on Europe? When's it come back to the U.S.? Is the U.S. immune to Europe I guess is my question.
Well, as I outlined in what I was saying, it's very difficult to figure that out. The models would suggest there's a modest impact. Casual empiricism suggests that if we read about it in the FT every day, it should have a big impact. But 1998 told us that it was actually a great year for the U.S. during a financial crisis. So I'll end on humility on that.
All right. But the sun is going to come up tomorrow, right? Oh, good.
It's been cloudy here for the last couple of days.
Yeah. Good point.
It's only cold.
Please join me in thanking the panelists for excellent job. Good job. Very well done.
That was terrific.